Welcome everyone to our fourth quarter market review, which I've titled 10 Days in the Hole. And if that now has put the song by Humble Pie, 30 Days a Row, into your brain for the rest of the day, it certainly has for me, and I'll be humming that all day long. So for those of you who know that song, but it is titled 10 Days in a Row because over the fourth quarter, the S&P 500 was down for 10 consecutive days. And this is the first time that has happened since Gerald Ford was president. So since the mid-1970s. So a fun fact and a little trivia about Gerald Ford too. He's got a little trivia as well, which is he was the first president that did not win an election. So the first and only president. So in any event, the S&P 10 consecutive days down, gave up some returns at the end of the quarter. We're going to look at how the markets did in this next slide here. And in the US markets, what that meant was the S&P finished the quarter at only 2.6%. So we started strong, gave up a little bit at the end, a lot of that with the uncertainty with after the election, people thinking about, what maybe tariffs might mean, where rates were headed. And so really that brought markets back to almost where they started at the beginning of the quarter. That said, the US equity markets finished up 23.6%. That means now we've had 2 consecutive years in the US equity markets at plus 20%. So some really strong performance over the last couple of years by the S&P 500 and the broad US equity market. Likely not going to experience that again for a third year in a row. But we've seen some just tremendous performance. A lot of that's been driven by the Magnificent Seven. We talked about those stocks, right? The large cap tech stocks, mainly Alphabet, Apple, Google, Netflix, Amazon, Tesla, as being the leaders. Certainly that's where a lot of the market concentration is around those names. But again, they've helped. It's been that large cap growth segment that has really powered this US market. An entirely different story in the international markets. Over the quarter, we saw international markets down 7.6%. For the year, they still were up at 5.5%, but really poor performance in the international markets. It's a much different story internationally. When you look at some of the central banks over there, they are, as we are, lowering rates. A lot of their economies, however, aren't as in good a shape as the US. And that's why we see some different performance even when we look at growth versus value. And I'll get to that in some of the next charts that we have when we look at the US markets and international. And in fact, it's a chart of the quarter we'll get to when we finish here looking at those markets. Let me finish on fixed income because we saw some volatility in the rates area. Long-term rates, intermediate to long-term rates were down or were up, That means the fixed income markets were down. That negatively impacts the fixed income markets. Fixed income was a negative 3% for the quarter because of that, because of the rise in long-term rates. So for the year, that really cut down a lot of the performance we saw fixed income markets achieve over the year. And for 2024, fixed income markets were only up now 1.3%. So really not a strong showing in the fixed income markets. Again, a lot of the rate volatility out there based on inflation, where rates are headed. Over the quarter, though, the Fed, as we mentioned here, has been cutting rates at the short end. Even though rates are coming down on the short end, again, they don't control that intermediate to long-term end of the curve, which is really what, when those rates move and that part of the yield curve moves, that's really what moves the fixed income markets. So, but the Fed is looking at the unemployment numbers and the inflation numbers, and they're lowering rates now. We're in that cycle. And generally, though, that does help the markets. And certainly as we finished out the year, some concern about how many more rate cuts were in the future in 2025. Let's dive into some of those markets into a little more detail. This next slide here, we look at the U.S. equity markets. We look at it by style. We look at it growth versus value. I already spoke to growth outperforming value. That's that top right-hand chart that's been going on for a while. Certainly over the year, that was the case. Growth led value, and that was because of the Mag 7. And then we also break it out by sector, and it's the same thing when you look at some of the sectors, again, because of the growth stocks, information technology, telecom, really among some of the top sectors over the year. Interestingly, consumer discretionary led the way over the quarter. So it wasn't really just growth stocks or that Mag 7 over the quarter. It would be good to see some balancing out in the U.S. equity markets and to see some other leadership as we go into 2025. In the international markets, this next slide here, developed has outperformed emerging. That has been a theme. What we're seeing though now and what we saw over the last year, 2024, was emerging markets began to outperform developed. And over the year, emerging markets were up 7.5%. versus the ACWI, which really represents all developed and emerging markets at 5.5%. So we're starting to see emerging markets really rebound from some very, very low lows, which is good and which is healthy. The other thing I'd like to point out in this chart is it's interesting to look at the performance. I mentioned a lot of the foreign economies aren't as strong or doing as well as the US. A lot of those central banks are a little more aggressive in terms of their easing and their rate cutting and monetary policy. For the year, you'll see large cap value or the large developed value stocks at 6.3% versus large cap growth stocks at 2.1%. So internationally, much different story where value is outpacing growth, where it's completely flipped in the US. A lot of that is, yes, because in the international economies, they're not fortunate enough to have some of the magnificent 7 stocks that we have that really don't only have power the US, but they're responsible they get a lot of their growth internationally as well. But again, these international markets are in a different part of the cycle, and where they are at in that part of the cycle, value tends to do pretty good too. Looking a little more specifically at each one of these major market asset classes, and in the fixed income markets, I already mentioned some poor performance there, rates rising. If you look at the top right-hand chart, looking at the yield curve, we've gone from more of an inverted yield curve from higher short-term rates and lower longer-term rates to a little more flat or positively sloped yield curve, where you have some higher longer-term rates versus the short-term rates. A lot of that's because of the Fed, of course, bringing down short-term rates, seeing long-term rates rise a little bit, but that's healthy. An inverse yield curve is not always looked at as being healthy. It preceded a lot of the recessions in the US that have followed. However, there's a joke out there, just because it's a negative or an inverse yield curve doesn't really mean we will be going into recession or there is a recession. I think the joke is an inverted yield curve has predicted 8 of the last 12 recessions or something like that. So healthy in terms of the yield curve and what we're seeing now in the fixed income markets from that perspective. If you look at the lower chart and you look at the sectors, cash again, really high short-term rates. Cash has not been a bad place to be. 5.3%, represented by 3-month T-bills. And when you're earning 5% in cash versus the entire fixed income market, again, which struggled, really gave back a lot of that performance in the fourth quarter at 1.3%. Certainly there was a big argument for stable value, cash equivalent type of assets, and that continued to perform well. Of course, as we look into 2025, with rates coming down lower, certainly that may change a little bit when you're looking at cash versus fixed income. Our kaleidoscope, our next chart here is really asset class performance year over year, and really just speaking to the power of diversification and why being diversified makes a lot of sense. You may not be the best performing, but you're not going to be the worst performing either when you have a diversified approach, which is that yellow box that says balanced, and that's a balanced strategy across each. Over the last 2 years, I already mentioned strong performance in the U.S. equity markets, driven by the Mag 7. We've talked about that again and again, but look at this performance by the large cap growth style. And now that's been the best performing style for the last 2 years in a row. And that just happened back in 2019 and 2020, where they really repeated year over year. And then it sort of mixes out as you go. Small cap growth was still the best, second best performer, but with fixed income and with that increase in rates at 1.3%, that left fixed income at the worst performing asset class for the year across all of the other sort of broad asset classes that we look at. To finish up, we like changing it up with our chart of the quarter. And this chart of the quarter is looking at the US versus international equity market valuations. I spoke to the big difference in US returns versus international returns. Just not over the quarter, it's over the year, it's over the past years. And when you look at risk assets and equities in general, though, even though US markets might be high, and certainly from whether it's a PE level or whatever type of ratio you're looking at, when you look across the board and globally at risk assets denoted by equities, it's interesting. You look at the international markets, and they are very attractive from a relative valuation measure compared to the US markets. And in fact, what this graph shows, it is really over the last 20 years, they've never been in a better or a cheaper compared to US than they are today. So if you're looking at it from that measure, that valuation measure, they are very, very attractive from that valuation measure, and down more than 2 standard deviations of where the average has been. And this goes over the last 20 years. So there are potentially still some attractive, valuations out there for risk assets. They may not be in the U.S., even though the U.S. is somewhat high right now. And again, having a diversified portfolio is very important, not just having U.S. equity, but having some international or global equities as well. So that wraps it up for the fourth quarter market review, 10 days in a hole, and wishing everyone a great 2025. And we'll see you next time. Thanks.